Awesome. Well, excited to continue this conversation. It's been a great day so far. We have two very special guests. Now I'll let one of you guys kind of get going here. Whoever wants to start.
Claudia,
you want to start?
kick us off.
Sure, thanks. Well, I'll start with a little quick introduction of GoldenTree and who GoldenTree is as a firm before I dive into the strategy. So GoldenTree was founded in 2000, so we're in our 24th year. It was founded by Steve Tannenbaum. Steve had previously been at Mackay Shields, and at Mackay he ran their high yield mainstay fund. And the investment process that he developed there, he brought over to GoldenTree, and obviously we've continued to refine it and expand upon it, but Steve's essentially been investing this way for well over 30 years. The firm overall focuses on credit. Everything we do is oriented towards credit, but everything from high yield bonds, broadly syndicated loans, private credit, distressed credit, structured products, and even emerging market debt sometimes. So it's a really broad mandate with respect to credit. But what we look for within the world of credit is credit that has a catalyst to drive value, right? So sometimes in some forms of credit investing, you often find people who, we use a certain amount of leverage to drive returns. If you have a plain vanilla strategy with really low yields, you lever that up and you get returns. That's very different from the approach that we use. We really look for credits that are mispriced, that are cheap, and that have a catalyst to get them to what we think is a fair value. So a bond trading at 80 that we think is worth par, and the company's going to restructure or refinance or issue equity or do something to drive that 80 to par. That's the type of investment that we look for. So we have really deep fundamental research. Our investment team is the largest part of the investment team is our industry specialist team, about 33 industry specialists, and their job is to find those kinds of opportunities, to analyze companies from the bottom up, do the research, find whatever part of the capital structure is mispriced, whether it's the bond, the loan. You could also do something in the world of private credit, or if it's not performing, if it's a distressed situation, same type of situation, and find that fundamental mispricing and find the catalyst that will drive that value. So that's really what we look for as a firm across the board, as we focus on credit, mispriced credit with a catalyst to drive value, and really across the board in the world of types of credit. Yeah, so we've actually been in this market for a relatively long time. I mean, the market overall is fairly short-lived, right? But so we launched our IDF fund in January of 2015. We were close to about $500 million in AUM in that fund today. And the driving factors, there's a handful of them. One, GoldenTree's had a long history of working with high net worth clients. We've been on a variety of wealth management platforms over the years, originally actually dating back to 2005. And over the years, obviously, as taxes became more important in the world of high net worth, as state taxes have gone up, obviously as federal taxes have gone up, we saw more and more of our wealth management clients beginning to pay attention to the after-tax returns of funds. And being in the world of credit, whether it's Golub strategy, GoldenTree strategy, credit in general is a yielding, income yielding type of strategy, and not necessarily always the most tax efficient. And so it was a confluence of the client's need for a tax solution combined with a somewhat tax inefficient strategy. So those two elements together, and with the third element of us doing a fair bit of work with high net worth clients. And so when you put those three things together, that was really the driving factor for us to consider and eventually launch our insurance dedicated fund in January of 2015. One of the points that you hit on is really spot on with respect to having more funds in this world, right? If you go back about 10 years ago, especially let's say at the wirehouse side, the large broker-dealer firms, they would only approve 2 or 3 IDF funds for their platform, and there's very slow adoption because from the financial advisor's perspective, you're looking at a menu of 3 and saying, well, if I allocate to Fund A and it doesn't perform well, I only have 2 other choices to go to. Whereas today the menu has expanded significantly, and with folks like you, there's obviously a much wider choice, and so that enables the adoption to be much greater. And really, I think it's being able to access a huge variety of funds is critical to that adoption. And I think you're still seeing fairly slow adoption at some of the wirehouses because of that more limited menu. So it's become much more single-family office, multi-family office, and RIAs that are coming to us.
What role does an IDF product / vehicle play in a diversified portfolio?
Good.
Yeah. The role of an IDF vehicle is, from my perspective, to access the strategies that you would want in your portfolio anyway, but just to do so in a more tax efficient way. It's as simple as that. From our perspective, our strategy's role in the portfolio is to provide diversification, to provide downside protection. I mean, if you look over the 24 years of our firm, we've had one down year in 2008. We haven't had a down year since then. And obviously there's been a lot of down years in the high yield market, leveraged loan market. The distressed index has been down. Obviously S&P and Russell and other indices have been down. Our downside capture is so much lower. So when I think of where the IDF makes sense in the portfolio, I think of it from a strategy perspective first. Are you allocating to credit? Are you allocating to distressed and private credit and high yield bonds and loans? If you're making that decision and then you want to do so in a tax efficient way, I think that those decisions go hand in hand. But I don't think you allocate to IDF just because it's tax efficient. You have to understand what the underlying strategy is, right? So thinking about where GoldenTree's master fund belongs in your portfolio, let's take a generic 60-30-10. With a fund that's had one down year in 24, we're in the true alternative bucket. This is a 10. This is not a fixed income replacement. Obviously, it's not equities. We belong in that true alternatives bucket. And once you've made that decision, then you can look at how to access it in a more tax efficient way. Yeah, I think to add to that, from our perspective, we're really agnostic with respect to rates in our strategy. Being a hedge fund, we can hedge out and generally do hedge out most of the duration in the portfolio. So we'll have some floating rate assets, and we're happy to take that floating rate benefit when rates are high. And when rates are low, we still have the ability to generate alpha from different strategies. When credit markets are performing well, but perhaps there's some kind of broader economic dislocation, spreads get tight. Spreads get wider, right? You can lend at a premium. And if you look back, say about a year ago from today, in the world of private credit, you could do first lien sponsor-backed acquisition finance at spreads of 700 to 800 basis points over SOFR. The strength of our strategy is that we can really pivot between distressed credit, performing private credit, performing public credit like high yield bonds and loans, or structured products as well, or asset-backed securities where we're structuring securitizations, or if there's a broad market dislocation like say in March of 2020, you can find or trade QSIP securities like residential mortgage backs or commercial mortgage backed securities at really dislocated prices. And so we really have the ability to pivot between all these different strategies, and that's where we've been able to generate returns in very, very different market environments. Whether rates are high or low, we're somewhat agnostic. We'll find different things to do in those different environments. For GoldenTree, one of the things I probably should have mentioned earlier is that the firm's a 100% employee-owned partnership. And while we have different investment teams focused on different, let's say, substantive areas, so we have our 33-person industry specialist team, but then alongside of them we have our private credit sourcing team, we have a distress restructuring and turnaround team, we have a structured products team. Across the top of all of these teams sit multiple partners, and as a privately owned partnership, the partners have a huge incentive to collaborate. So in the world of private credit, because we have this really deep industry specialist team, we will actually look at every industry. There's no industry that we won't rule out. In the world of retail, won't touch retail, and it's understandable. Not all retail is attractive. One of the best deals I think we've ever done in private credit was a retail transaction, but it was a company that had zero net debt prior to our one turn of leverage. Oftentimes LBOs are being done at 6, 7, 8 times leverage, so one turn of leverage is extremely low. This company also had 60% positive free cash flow. So when you can find that kind of gem in the world of retail and create a private credit loan that nobody else will touch, you can actually get a really wide spread because you become the sole lender in that deal, because many other people in our industry, in the world of private credit, won't do retail. And so we have the ability to find those hidden gems in certain sectors that other people just for good historical reasons often, whether it's energy or retail, there's been a lot of volatility in those sectors, but you can still find individual companies that are really attractive. And so that's really what we pride ourselves on is finding those more complex situations, a little bit off the run perhaps. Maybe we need to work a lot harder to do those deals, but we're going to get compensated for that harder work. In the world of performing credit, again, whether public or private, generally the minimum asset coverage we're going to accept is 1.5 times. So you could theoretically, I guess the inverse of that is the loan-to-value ratio of about 66% or so. You could theoretically lose a third of the value of the company and you still have 100% coverage. Now, in order to get that value, sometimes you do have to go through distress and restructuring, right? You can work out, or you can take over the company and take it through a full bankruptcy process. But at the firm, we've done over $30 billion of distressed investing. And so we have that really, really deep in-house restructuring team. And so we have the ability to take over if needed. Now, similarly to Golub in the world of private credit, that's not your expectation, right? You're trying to really do the underwriting up front to avoid those kinds of situations on the back end. But we go in with a very healthy dose of skepticism, because we've seen a lot of transaction, particularly in the last year to 18 months, where sponsors have not necessarily supported the company. And we've also seen their sponsors doing things like stripping out certain assets of the company, stripping out subsidiaries. If the covenants aren't strong enough to keep them in there, they can take value out. So you might have a certain LTV or loan to value ratio going in, your value just declines significantly if the sponsor has the ability to move something out. You also have what's called up-tiering, where you might be first lien, but again, if you don't have the right covenants to protect you, the sponsor has the ability to create additional, more senior debt and essentially cram down your former first lien. And so we actually use our legal team that works in our restructuring and turnaround business, that's done the $30+ billion of distress. That's the team that structures the covenants for us in the world of private credit, because we know the games that can be played on the back end, and covenants are a really, really important way of protecting yourself. The fundamental underwriting and understanding the business, looking at asset coverage and all those elements are step one, but step two is really that deep covenant protection. And so having that restructuring and distressed expertise in-house is critical, we think, to protecting should a company ever get into that situation. But I'll point out that in our private credit loans, we've never had to do that. We've never had a loss on the private credit side, but we tend to be much more focused in our private credit loans that we'll doing maybe 20 to 30 a year, not several hundred. So it's very, very credit selective to begin with, and that's part of why we've been able to avoid any losses in private credit to date.